think this is on. Hello, everyone. It's super great to be here with you all today at the Staking Summit. A big thank you to Staking Rewards for having us. My name is Ashwanth Samuel. I work at Protocol Labs, and specifically, I work on Filecoin DeFi. You might be thinking in your head, like, Filecoin, like the storage network has DeFi? It does, and it's been growing incredibly quickly, although it is an emerging ecosystem. And so I have a very unique opportunity today to be joined by some experts on this panel, where I'm going to be in your shoes as well. I am an audience member just as much as I am a moderator today, learning about how to grow a DeFi ecosystem, specifically from the institutional perspective. So with that, would love to get to know our panelists a little bit more. So 3 questions for you all. Who are you? What organization are you part of? And can you tell us a little bit more about your first experience with DeFi or liquid staking? David, take it away.
Thank you. My name is David Walsh. I'm the sales lead at Alluvial. Joined Alluvial around 2.5 months ago. Prior to that, I was at StakingRewards.com, the company that's hosting the event today. So I've been in the staking space for around 3 years now. Joined Liquid Collective and Alluvial around 2 months ago, as I said. Really focusing on servicing the needs of enterprises, institutions that have strong kind of compliance and regulatory security needs. So I guess when I got into DeFi, I learned about Bitcoin in 2015. Slowly but surely kind of started going down the rabbit hole, and then by 2021 I was fully in, working with Staking Rewards.
Great, thanks David, thanks for joining. Marin?
Hi, I'm Marin, Master of Protocol Relations, contributing to Lido DAO. My experience predominantly comes from startups and advising unicorn company for investing into startups. So my approach to institutional capital was from VC side. Started helping myself, and that's what brought me to this type of role, which also includes DeFi, which is an awesome part of cryptoverse. Essentially, Lido protocol is institutional grade liquid staking, but I like to highlight that it's staking for everyone. So it's not only for institutions, but everyone at any point of time can interact with the protocol. Additionally, I would like to make a distinction between the protocol itself, which is a middleware on Ethereum blockchain, has a purpose of connecting the users with their ETH and delegating it to the node operators and their validators without interaction with the asset itself. So at no point in time, the protocol has custody of ETH or STETH. My first interaction with DeFi, I guess at the time when Atland was pitched, or IDEX was the place to go to make a P2P swap. I actually originate from the age where everyone complained about UX, which is so much worse than this current UX everyone is complaining about. So,
good to know you've been around the block for a while. Awesome. And Mohak, go for it.
Hi. Hi, I'm Mohak Agarwal. I'm the founder of ClayStack, which is a multi-chain liquid staking protocol with primary focus on Ethereum. My background is in computer science and finance. Prior to ClayStack, I was running Wolfedge Capital, which initially started as a Web3 fund, then transformed into a staking as a service company with around $200 million assets under delegations. I always saw, because I was so exposed to staking, I always saw illiquidity or inflexibility as biggest barrier in staking. And that's what led me to start ClayStack to solve liquid staking. My first interaction with DeFi in the last bear market, when Ethereum was trading at very low prices, I just wanted to invest in more startups. And I did not want to sell my Ethereum. So I started using MakerDAO a lot to mint DAI at that time to be able to kind of mint or get my Ethereum back later on, and then obviously rode the whole kind of yield farming and all those waves. Yeah.
Got it. Well, as you can see, we've got a pretty diverse panel up here with a wide variety of experiences. And so, Mohak, I want to start with you. I think in order to understand how to attract institutional capital, we've got to go back to the beginning. So what were some of the first groups, or who was interested in liquid staking right out of the gate, who initially?
In the beginning, it was mostly retail audience because people do want like flexibility in their life. When they saw staking, they were like, if I stake my assets today, in order to get them back, I have to wait for unbonding periods. And that created disincentive at the first place to stake. So the biggest promise in the initial days of liquid staking was just flexibility. And then as we grew, then more use cases came around, which was like primarily around using these assets and DeFi to earn more yields. But I think just the flexibility to get your principal at any time back was the biggest one in the beginning.
Got it. And so we now have one side of the coin where it's about the users who are interested in staking. But Marin, talk to me a little bit more about the narratives for the ecosystem on that side. Why is staking so vital for ecosystems?
It has multiple angles. So as just explained, it started from retail, and it's important. It's a public DeFi primitive, right? It's the source of rewards where everything is based. But most importantly, it goes back to the actual consensus, to the blockchain itself, how it's shaped and how the blocks are closed. It's securing the network. So we do name it staking, but it's not traditional staking, which would relate to giving your funds to the bank, and then they give you an interest for that, meanwhile consuming third-party products. No, here you actually delegate your assets, and in return, your rewards are block closure rewards or validator emissions. Where institutional side comes in here, it's a very specific and spotlighted niche. It resembles fixed income product, right? So what's important for institutions is to have this predictability. So we know the emissions, and we can predict, even on Ethereum, depending how much stake comes in, what would be the future rewards. Similarly with other blockchains, they literally write out emissions years in advance. So when you are an institution and you want to have that security and to remove the risk from the actual income, right? Especially if you are long on the specific asset, right? You expect the rise in value in future.
Right.
It reduces the risk significantly.
Right, right. And so I think what both of you are kind of hitting at is initially a lot of the adopters of liquid staking or DeFi protocols are on that retail side, and that's something that we've seen in Filecoin as well, where in the past 6 months we've seen 130 million USD in TVL, which is very exciting. But we want to try to shift that to institutional. And so David was wondering when you help me understand and the audience understand, when does that shift happen from the retail to the institutional side? What factors need to exist?
Yeah, so like when I joined Staking Rewards, that was 2021. There was obviously a lot of retail interest, but I think even at that point, there was quite a bit of institutional interest too. More on the crypto native side for sure, but like even the likes of Bloomberg, multiple different funds were using our staking API to get for their own research, for their own investments. But I think really Shapella and the merge in general has definitely kind of accelerated a lot of institutional interest in the space. I think like you look at today, like BlackRock filed for the spot ETF yesterday, 3iQ went live with a staked ETH ETF in Canada last month, and I think this is a trend that's just going to keep continuing and growing. So it's been slowly but surely, and then takes off pretty quickly. So I think we're here. Institutional adoptions are in the corner, and yeah, positioning ourselves to be at the right place at the right time.
Definitely. And so you mentioned a couple of exciting names there. Oh yeah, go for it.
I actually have a bit different take on the ETF. Primarily, I mean, everyone is not going to like it, but I feel like any institution who really want to invest in crypto can still do it. Like even if they cannot hold crypto in their books, like they can create SPVs in multiple ways. I feel like ETF will definitely solve like retail audience very, very heavily. Like right now, if any retail audience wants to buy crypto, it's so difficult. They have to go to an exchange, to KYC. I mean, KYC is fine, but deposit their money, then get those assets out, store private key of MetaMask. always be concerned that it's not going to get hacked, versus being able to buy Bitcoin or Ethereum directly from your favorite stockbroker, and and just like being relieved that it will never be able to, or no one can transfer it or can hack it, I think is a huge probably step towards bringing retail interest more via ETF than institutional.
Interesting. So yeah, maybe some of this news might be both retail and institutional, but I think that's a very fair point. So getting back to the institutional side of things here, when you mentioned a couple of pretty big names that are getting into this, but what are some of the characteristics of institutional investors? You know, there are subsegments.
Can enable them. And so to answer you directly, majority of institutional types already today interact with staked Ethereum, Lido staked Ethereum. I would say they interact with other projects as well. I'm not saying we are exclusive at this, but being the largest one out there, only battle-tested solution where the protocol itself handled over $1 billion of withdrawals, tick-boxed deep security analysis, right? And number of audits, it all has meaning into this. What we are changing here is the face of the whole industry. Previously, we were known more as DeFi degens, so to speak, right? Now, the talks are to put faces to those nicknames on Telegram, to go more traditional, to emails, to Slack, to enterprises, to go back to the traditional way and actually onboard them, involve them more. So it brings down hand-holding a lot. Yeah, so industry is changing in this direction.
Yeah, that's funny. I might be the only person in this room who prefers email over Telegram, so I'm aligned with that.
There with you.
Well, that's great. Well, and so I think you hit on a lot of points in Mohak. I want to follow up with you in 1 second about some of the points that you made. But David, do you think that institutional investors care about the narrative? Or do you think they really only care like the narrative of an ecosystem or the utility that something is providing? Or is it truly just some of the aspects that Marin mentioned?
They definitely care about the narrative. I think from my discussions, like a couple of the ones that they're definitely thinking about is around regulation, compliance, and security. So they're the three. In terms of the regulatory side of things, America and the US in general is still a little bit slow on that side. I think it will come eventually. Shout out to Evan Weiss, who is the head of business at Alluvial, and he's the leader of POSA. they were in DC last week talking with the SEC, talking to them a little bit about staking, traditional staking, but also liquid staking. So doing great work on that side. I think as well on the compliance side, a lot of the asset managers and offices that we've talked to, they do require some level of KYC, AML to be done, like in terms of having a clean pool of ETH. And then also on the security side, so like who are the node operators, what audits have been conducted, is there SOC 2 compliance? Yeah, there's quite a bit to it. But when you're talking about institutions, they're the kind of three that I see, and then of course liquidity.
Yeah, and Mohak, I want to ask you specifically about the security piece. What are some of the most important features that a liquid staking service needs to have from a security perspective in order to work for institutional capital?
I feel liquid staking primarily has three risks. One is the smart contract risk, which exists across all DeFi. Second is the price risk, that if the asset that you are liquid staking, if the asset price goes down by 10%, you probably lost like 3 years worth of yield. And third is the slashing risk. If the validator goes down or double signing, then you are losing principal itself. If you are able to hedge all these three risks and build a structured yield product that we eventually want to build, then you are looking at like pension funds, endowments, big capital, because right now, yes, US Treasury bill yields are very high, but that's not going to be the case for long term. And institutions know that. And they're looking for something where eventually they can bring hundreds of billions of liquidity with a stable yield. And all these three risks actually can be hedged today as well. But today the problem is it's not cost effective. It's very difficult to hedge price risk, for example, cost effective manner. Smart contract risk, the premium that most of the insurance are underwriting is again like way high. They're only able to underwrite the part of the pool risk, not the full AUM. So, but in a few years, this will change. And then you are looking at like attracting hundreds of billions of capital.
Yeah, and I'll give you an opportunity to expand here. Specifically, how does ClayStack, solve some of these security risks for those who are interested in using the platform?
So one of the thing is, for example, for institutions, they look for KYC at every point, but at the same time, they want censorship resistance. And it's hard to find that balance. So what ClayStack does is, we have a modular DBT-based architecture, which is distributed validator technology, where none of the nodes are being run by single operator or single validator. It's being run by a cluster of operators, where if one goes down, then the other can take over. If one tries to censor one transaction, the other will not censor the same transaction. If one tries to mistakenly or knowingly do any malicious transaction, others will not agree to it. So that creates kind of an architecture which is secure, scalable, and somewhat decentralized.
Got it. Yeah, and Marin, I want to flip to you on kind of functionality and scalability, right? These are themes that we've heard all throughout today. Attracting institutional investors is on everyone's roadmap, but it needs to be easy for them to use, and it also needs to scale to more institutional investors. So, Marin, how do you find that balance between those two factors?
It's actually hard part of the balance to find, but it circles back a bit to these questions previously asked. And they both highlighted, which is interesting to me, because how different staking services or staking providers are positioning themselves differently in the ecosystem. So for example, from my perspective, when I go to the bank and bank KYCs me and my capital, I don't need to know KYC, KYB of their service provider, right? So where Lido is positioned is in the middle, same as that service provider. You don't expect your bank to run your validators or staking services. They use external providers, right? So you need to be satisfying all those boxes that we just discussed, and then to bring that balance of interaction, ease of integration, and then the most important part that brings power to the liquid stake tokens there is the liquidity, right? What institutions need is a fast way out. If you don't have enough liquidity to satisfy the demand in case of black swan events, you will never scale. Yeah. And then we get to the chicken egg problem, essentially, because liquidity is not easy to get, especially if you're going to the direction where liquidity needs to be fully KYC. Right? Now we are talking about the different approaches to market, and what I want to highlight first, there are no specific regulations today that regulate this. So everything is compliant. There's no regulation that says either of the protocol is or is not compliant, so we are all wild guessing. So we are taking different go-to-market strategies, different regulatory strategies, and we are giving you best bet, right? But then back to the capital. Essentially, if you have it free-floating, the asset is free-floating in DeFi, specifically now talking for Ethereum, it's really, really hard to control those aspects, like who interacts with the asset. So the logic would be if you control the on-ramp and off-ramp, plus you know where the emissions come from, it's super simple. Right. If you go deep into rabbit hole, then it becomes super complicated and it's never going to be institutional grade, right? They don't need complications.
Right. So a follow-up question for you there then, do you think it's easier for institutions to just purchase a staked asset off an exchange, or do you think they should actually go through the whole process of staking with the provider?
If you are talking about a bank,
yeah.
Definitely. Yeah. Like for their customers, it's much simpler for them to just swap. If you are talking about capital allocators, portion of them already interacts with vanilla DeFi. Right. For them, it's cheaper, right? More capital efficient to do it themselves because they have know-how. They have the security part solved because they either use qualified custodians which have native integrations, or they use hardware and software that's good enough for them. So it all comes to what type of institutions are you targeting to service. Where I sit or stand, I don't think all the protocols will be able to serve all the type of institutions. It's impossible.
So you're very much aligned with go after a specialized segment, or go after one segment, build a specialized product that fits both the flexibility and scalability for that specific segment, and do that until you're able to kind of expand to other.
Essentially, more segments you cover, more successful you will be.
Yeah, that makes a lot of sense. Well, I want to do a quick kind of round robin here in our last five to 6 minutes of, I want to understand, what are the most important tooling or features of a liquid staking platform that must exist in order for institutions to adopt these platforms. So David, we could start with you.
Yeah, so we have an API-first approach. So we have all the APIs. We work with integrators. We have reward reporting APIs as well for them to be able to calculate the rewards, obviously, for their end users. We do have the compliance piece in place. So we work with a third party called Exeter, who was recently acquired by Capgemini. They review the KYC and AML policies of the integrator. So it's not each individual going through the process. They kind of go through with like Coinbase, Bitcoin Suisse, for example. And then obviously I think the liquidity is like a key major part. So making sure that you're working with market makers, OTC desks, and making sure that institutional capital can get out, much to your point.
Got it. And just following up on the first point you made in terms of pulling out all that data, what are some of the most important metrics that matter to institutional investors?
Yeah, I think everything around consensus layer, execution layer, rewards. I think the more granular you can get, the better. And I think we're still early days, but I think that's probably key of where everyone's looking at right now.
Got it. Same question to you, Marin. In terms of tooling or features that a service must provide, what are the most essential for institutions?
From our aspect and all the interactions we had so far, access to liquidity, so infrastructure access points. Yeah. It's what makes the difference.
Got it. Can you give me just a couple of examples of those access points?
So you can put it like even traditional stock exchanges, more familiar to us here, crypto exchanges, OTC desks. It all needs to fall in place to be simple for institutions to execute in their familiar environment.
Got it. So for any service providers that are building liquid staking solutions, you would recommend that they go and work with all these different access points and set that up for their eventual customers or
exactly.
users.
Like the whole logic behind it, when you deploy software on Ethereum, it's there forever. Like, you don't need random front end to access it. If you have enough access points and it becomes a public good, you achieve the ultimate goal of decentralizing Ethereum, creating an asset that everyone can interact with, retail, institutions. It's as safe as it gets. You can never say something is safe and secure. I mean, let's go back to the merge. Like, why everything skyrocketed after the merge? Because now we can breathe. You never know if the upgrade will succeed, right? So there's always that type of risk involved.
Got it. Makes sense. And Mohak, same question for you.
I think David and Marin has already added good points. One of the points like that I would make is for institutions, like if they just wanted to earn any staking yield, they would do regular staking. It's much cheaper, as Marin said. Like they already have a technical know-how. They can afford to have a technology team. The reason they go to liquid staking is because of the same reason that retail came in, which is leverage on those assets. So, and the beauty about institutional liquid staking is that in terms of traditional or retail liquid staking, like different protocols have different ecosystems. But here, everyone is like at square one yet. So once I think like you are able to use those assets across DeFi, which is again like institutional DeFi, you are able to leverage those assets. I think that would be like something more enticing for institutions.
Got it. Makes a ton of sense. Yeah.
One thing that kind of just crossed my mind, which is a phenomenon for this industry. Like, you see institutional DeFi, but it overlaps with retail DeFi. So it's
Right.
very, very unique.
Right, right. And do you think it's important that those are separated down the line from a, framing perspective or from an actual service provider perspective?
I don't have a crystal ball,
Okay.
so it depends on the regulators and compliance,
Yeah.
right? But we might see a future where it remains together.
Yeah.
Got it. Got it. So going back to, I know I've been talking a lot about Filecoin because it's near and dear to my heart. But as an emerging ecosystem in DeFi, here's where we're at. We're number 25 ranked protocol in TVL across all of Web3. We've seen a lot of growth. What are the biggest pieces of advice that you'd have for someone like me or the Filecoin ecosystem service providers building in this world? David, we can start with you.
I think having a clear node operator strategy, kind of a growth strategy is key. I also think thinking a little bit and working with regulators, like trying to get a feel and understanding of what the industry could potentially look like in the medium to long term, and really building around that for like a long-term sustainable, ecosystem in general. So that's what I would say.
Perfect. Marin?
My advice would be more to a protocol level, to always think long-term, go for simple tokenomics, right? And think sustainable. Each cycle, something new is trendy now. Previous panels you could hear about airdrops, and it's what drives engagement, drove engagement during this bear market, but it's not something sustainable, right? So you need to think about business models and how do you plan to make your revenue of the protocol consistent and long-term. You can't even rely long-term on VC funding, right? If you don't have the numbers, you will not have the funding.
Yeah.
So sustainability and ultimately for the ecosystem composability. So that would be extremely high important to have the backing of the foundation, to do the connections between the protocols, to think ahead, to make products that work together in unison compared to cycles that Ethereum had to go through, where everyone was testing in production and deploying various types of dApps for itself, and then years after started to combine them and do the products jointly.
Right. The good thing is the playbook has almost already been written.
Yeah.
Yeah, Mohak, to you.
Yeah, one of the things I would say is like in DeFi, decentralization and scalability does not go hand in hand. So it's very easy to build a protocol which is very scalable and probably centralized. And that's one piece which is very, very difficult to fix later when you grow a lot. So, and decentralization, obviously it's a journey. It's not like it doesn't happen on day one, but have that in your roadmap from the beginning itself. Like think about it that it needs to be decentralized someday. So versus making like a completely centralized architecture in the beginning, then it becomes impossible to decentralize at some point.
Right, right. Well, thank you all for your time, Mohak, Marin, and David.
Thank you.
We just ran out of time, but thank you all so much for listening. Really a big thank you as well to Staking Rewards for putting on an amazing event this year. And if you want to learn more about Filecoin DeFi, you can check out an event we have at the Swiss Hotel on Wednesday, November 15th. We'll have a couple of teams there that are building DeFi solutions. You can learn a lot more about them. Find me, I'll be in the back of this room today. But thank you again to all of our panelists. Thank you to Staking Rewards, and we'll see you next time.